Geez, Chris, I mean, what was it, Christmas Eve 2018, when the stock market was finally catching down to all of the liquidity that the Fed had tried to withdraw? And then all of a sudden, I mean, anybody can go back and look up this stuff. I mean, I'm not just making this up. I mean, Secretary Mnuchin called a meeting of the, people call it the Plunge protection team, but it's the president's working group on capital markets, looped in heads of the major banks, and they had this emergency call on Christmas Eve 2018. And by the time the markets reopened, day after Christmas, the Dow went up 1,000 points.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and quite excited today to have, I know I like all of my guests and I say they're all my friends, although really one of my favorites. Craig, as I was writing your intro for my book, I mentioned how over the years, whenever you had a new interview or article coming out, was always one of the things I looked forward to most, because I really love the way you look at the markets, respect your opinion. So I'm joined by the great Craig Hemke of TF Metals. Real quick before we get started, hit the subscribe button and also that little notification bell, so that when I'm fortunate to have great guests like Craig on the show, you can know right away. So intro aside, Craig, great to have you here. And how are you doing today, my friend?
I'm hanging in there, Chris. Thank you for the kind words. I appreciate it. I don't know about the great stuff, but I appreciate it anyway.
Well, I know you're a modest and humble guy, so I will say it, and you don't have to comment on that. Although excited to get your comment on a lot of things that are going on, and perhaps something I know is on everybody's mind. We've been hearing a lot about the coronavirus, which, not expecting you to have the answer to that, but obviously we hear market up on coronavirus, down, gold doing this or that. So any thoughts you have, and perhaps how you approach, should we be taking any market activity and connecting it to that, or how do you see all that right now?
No question about it. The global central banks are going to think they can cure them, and they already think they can cure anything with cash, right? I mean, last week, the Chinese returned from the New Year holiday. And what did the People's Bank of China send out the most yuan that they had in 5 years or something like that, something like 2 trillion yuan, to try to provide liquidity and pump up their markets? Okay, this is not like covert anymore. I mean, it's just all done right before your eyes. I mean, what percentage of the Japanese market does the Bank of Japan own, right? Yeah, we can go back to, geez, Chris, I mean, what was it, Christmas Eve 2018, when the stock market was finally catching down to all of the liquidity that the Fed had tried to withdraw? And then all of a sudden, I mean, anybody can go back and look up this stuff. I mean, I'm not just making this up. I mean, Secretary Mnuchin called a meeting of the, people call it the Plunge protection team, but it's the president's working group on capital markets, looped in heads of the major banks, and they had this emergency call on Christmas Eve 2018. And by the time the markets reopened, day after Christmas, the Dow went up 1,000 points. Yep. Okay, so this isn't like, I'm just, making this stuff up. This happens. I mean, the banks are going to provide cash to keep things, appearing as normal as possible. I didn't even think, Chris, it's not at this point, because we know that's what the central banks are going to do, that some of this stock market rally last week and again this week is just people front running this now. Yep. They're like, well, hell's bells, we know what's coming next, another $1 trillion and another trillion euro and all that jazz, and it's got to go someplace. So anyway, how does this relate back to gold? Primarily, and eventually silver, I suppose, the mining shares and all that kind of stuff. Look, people need to understand, this is not, gold going up is not directly related, just to the virus and can be written off, or just to the war fears we had back in early January and thus can be written off. No. Let's look at the big picture. Gold traded sideways for the better part of 5 or 6 years, couldn't get above 1350. The whole time, the Fed was telling everybody, we're going back to normal, right? We're going to trim our balance sheet. And they actually managed to trim like $700 billion off their balance sheet over a period of 5 years. It took them 5 years, Chris, to go from like 4.5 trillion to 3.8 trillion, or 3.7 trillion, something like that. And now, since they turned that spigot back on in October, less than 5 months, they've already put on 400 billion back on.
Yep.
So what gold's responding to is, if you go back to May, when we first broke out, May of last year, 1280, something like that. Then gold finally started to anticipate these rate cuts that were coming, because the bond market was rallying and the yield curve was inverted. So gold started rallying because of this clear reversal of the Fed and other central bank policy. Then it pulled back a little bit. Then we got into October and November, and now here comes a full blast of cash for the repo crisis, and now direct debt monetization that the Fed is doing. And we shot another leg higher. And that's, with this virus, that's now just going to continue. The global economy is already worsening. They can't withdraw liquidity. And so gold's just going to keep stair-stepping higher. I mean, of that, I'm pretty certain at this point.
Yeah, and it's interesting you mentioned the Plunge protection team, which sometimes I mentally envision like that scene in The Godfather with the 5 families and you just replace bankers, and maybe it really isn't all that different. Although especially a week ago when Sunday night, Shanghai index down 8%. Yeah. I remember waking up Monday morning thinking, gee, I wonder how much the U.S. markets are down. See the Dow's up 350 points. That seemed hard to imagine there wasn't someone in there.
Yeah, that's pretty fishy too. And that's why I mentioned that Christmas Eve thing. I mean, if anybody listening to us thinks I'm full of baloney, just Google. December 24, 2018, Mnuchin, President's Working Group on Capital Markets, whatever, however you want to Google it, you'll find the stories from that day. It was an emergency call. It just really fallen off a cliff at the end of December that year. And then magically, after that phone call, the next day, straight back up. So, yeah, I don't know if it's front running, if it's just, hey, the market just goes up, or we have to make everything look normal. So therefore the call goes out on whatever that is, Friday, January the 31st. It says, okay, China's going to open Sunday night. Be ready. And they did go down 8%. Be ready. Get on the bid though. We got to, kind of like go back to election day. Remember that was infamous story, or after Brexit, when all of a sudden, and again, here, I'll give you one more stat, Chris, and I'm sorry to be kind of laying this monologue on you. The Fed is fighting illiquidity, right? I mean, just today, as we record this, another something like $67 billion of repo, was pushed out, even though the demand was like 90 billion, it was oversubscribed. And that was the problem. They were shrinking the balance sheet, shrinking the money supply. Stock market started to collapse and all this kind of stuff. They are fighting global liquidity because of all of the debt and the U.S. government soaking up cash and stuff because of the $1 trillion deficits, all these things. Okay. The last thing they can afford is the stock market to go down. Well, why? I mean, think about it. What stock market total market cap now is like $25 trillion. Okay, if you add up the market cap of all the publicly traded companies, what if we had a 20% correction? I mean, that'd be $5 trillion.
Yep.
I mean, they're doing their best to pump in $60 billion a day. What are they going to do if $5 trillion just evaporates? So they're going to do everything they can to keep the stock market from going down, or they're going to continue to do everything they can to keep the stock market going down. And eventually, again, that understanding trickles over into demand for the precious metals in all their forms: futures contracts, unallocated accounts, ETFs, mining shares, you name it.
Yeah, I think you're right. Where, again, do I think the stock market's a bubble? Sure. But do I see any way the Fed ever stops? It's kind of hard to picture it. And interesting, I was talking with our friend Denver Dave Kranzler last week, and we were looking at Tesla. Interesting, that spike up really started in September when the Fed repo line started. So I guess they're getting the effect that they were hoping for. And speaking of the banks, of course, everyone's favorite bank, JP Morgan, who looks like the Department of Justice now potentially charging the bank as well. Although what I remain a bit baffled about is that they talk about spoofing, they arrest people for spoofing, yet we see these mysterious spikes down. in the market, which it's like, all right, what you're arresting them for is continuing to happen, and people are losing money. People are trading and losing to this. So I know a lot of folks are wondering, is this a legitimate investigation? Is it just another dog and pony act, horse and pony act, whatever you call that? What do you think's actually going on there?
Well, we've known about this. I know Andrew McGuire has been telling me since about 16 that the Department of Justice was getting involved and that this was changing everything. Well, okay, maybe. I mean, it looks legitimate. I don't know. I guess I'm focusing more on the bigger picture. I'm not sure JP Morgan's role in gold is as significant as it is in silver.
Right.
I think HSBC plays that role in gold globally as custodian of the GLD and, kind of a primary physical delivery bank in London. But it's noteworthy, obviously, that the Department of Justice is involved. And I think we may have talked about this last fall, Chris, and it came up last week again with the latest update from Bloomberg. And that's that this process and these indictments are proceeding under the RICO statutes.
Yeah.
And the RICO statutes were put in place to combat organized crime back in the 80s and 90s. And ostensibly what it meant was, the hitman could whack, Jimmy the Chin, and then you go after the hitman, but you could never go after the boss.
Right.
The RICO statutes allow you to kind of move up the corporate ladder and rope in people higher up the food chain. And so using the RICO statutes to go after JP Morgan in this way is intriguing. It's already a criminal organization. I did a thing with Rob Kirby last week where Rob just started rattling off the list of fines that JP Morgan has paid over the last 15 years. And it's billions of dollars. It's billions of dollars. How nobody even seems to care. CNBC puts Jamie Dimon on their air like, he's some kind of savior when he sits atop of an organization that just routinely breaks the law, breaks the rules, and figures, screw it. We make more money in screwing everybody than we have to pay out in fines, so just keep on rolling. So would a RICO thing go all the way to the top? Yeah, I doubt it. But what it does do is it maybe puts them on notice for their precious metals trading, and that of the 6 or 7 people that have been indicted so far, the main one is all these guys' boss, a guy by the name of Michael Nowak. Yeah. And what's significant, and this is the kind of stuff that people need to understand. Nowak was, for the period involved, 2008, 2016, was the head, or for part of the time, was the head of global precious metals trading for JP Morgan. Okay, you'd think that guy, just takes a limo to work every day and lives pretty cozy life in New York. But Michael Nowak, until this indictment came down, was also on the board of directors of the LBMA in London. Well, what the hell? What? Why would that be? Well, and what people do, again, it just amazes me that I don't know, people just don't take the time to understand this, whatever. But the futures trading kind of works hand in glove with the physical desk that these banks operate. Okay. And they try to move the price around so that either physical orders on the books don't get hit, or if they need to come up with some metal suddenly to fulfill a promissory note or a lease that's coming due, then maybe they can rig price down and find some sellers. This all works together. The New York and the London desks work together. Yep. Okay. But it's amazing to me that people either don't care to try to understand this or just want to gloss it over and say, it's no big deal, man. It's spoofing. Everybody does it all the time. Well, that's bullshit. That's just laziness, if that's how you're going to look at it. So this is a significant investigation. It'll be very interesting to see how it plays out, but then also what it does to the bullion banking business of a place like JP Morgan. What we hope for, in a traditional business sense, is these banks just finally say, screw it. This just isn't worth it. Why are we even dicking around with this stuff? We're not making any money at it anymore. We're on the hook for all these, all the leverage and all this kind of stuff. And so hopefully that's the direction this trends. Because if we get the banks and the derivatives out of the pricing scheme, then we're finally going to get back to some actual physical trading to determine price. And that's what we're all hoping for one day.
Go imagine that, actual buying and selling of the asset, determining the price. Interesting what you mentioned about the mechanics and how they know where the stop orders, they're working the customer books. That was one of the things I asked Bart Chilton about last year, which he confirmed as well. So again, this isn't just you or I speculating. Um, Another thing I had on my list that I've been excited to ask you about, we saw this pattern for the last however many years where the banks would get long or close to flat. You'd see the price of gold and silver go up, then they get really short, you see it go down, which really held until that rally of last summer because we hit that point where they got really short. And yeah, we've had some spikes down, but we haven't had gold back to 12 or 1300 or silver back to $14. We also saw the reports whether metal actually goes into these ETFs
Right.
that someone appeared to be buying. I'm wondering, is it World War III going on underneath the surface right now? Are they throwing the kitchen sink in? Or what do you think's actually happening aside from the price sitting around 18 bucks in silver? What's really going on beneath the surface?
Well, probably a lot of the same stuff that has been going on as long as I've been doing this for the last 10 years. And the banks are just simply trying to match up physical metal with their obligations that they've committed themselves to in the futures market. And that's, again, part of that picture is in New York, but a bigger part of that picture is in London, where they trade, thousands of metric tons a day in unallocated metal. And until anybody calls them to the carpet and says, hey, hold on, wait a minute. I'm not playing this unallocated crap anymore. Okay. I want the actual thing. And you begin, you reach a crisis point, a literal run on the bullion banks of physical metal, then the game, just continues. It's a confidence scheme, if you will, right? It continues as long as there's confidence. I'll play your unallocated metal game and save on my storage fees as long as I feel confident that if I ever really want my metal, you'll deliver it to me. Okay. And I'll store it at UBS in Zurich, or I'll, let you pretend like I have it in London or whatever. But when the time comes and all of a sudden there's a delivery shortfall, because again, the system is, you get this one little ounce, and then you got all these derivatives stacked on top of it, not just futures contracts, but promissory notes and leases and all this kind of stuff. And the thing is levered, God knows how many times. Each ounce has 10 beneficial owners or 50 beneficial owners. Nobody knows. Okay, that's why price forecasts that say, well, I think the proper $10,000 per ounce. Nobody can say that because nobody knows how many ounces there actually are. Okay, how can you? Anyway, that's a whole other story, I suppose. But anyway, as long as that confidence, okay, I can always get my metal if I want it, continues, then the system will continue because the banks aren't forced to deliver. That's where, and you and I have discussed this before, and it remains now at the forefront of a lot of people's minds. That's where palladium could possibly be a trigger. I don't know. We've had futures market collapse before. People can read about the Simplot story and Maine potato futures back in the 70s when the futures market collapsed. There wasn't potatoes to deliver, just like there may not be palladium to deliver. And it was a story for a day, 45 years later. But it wasn't, some big, but now if there is some kind of collapse in the palladium market, my hope, and I hope that it's not just a story for a day. That the hedge fund managers, the Stan Druckenmillers, the Ray Dalio type people of the world that say that they own gold when in fact they own the ETF, and they line up and they say, I want my gold. And the authorized participants of the ETF, the bullion banks like HSBC say, sorry, read the prospectus, dude.
Yep.
And then Stan Druckenmiller says, well, screw this. I want physical, and then you get that run. That's what we can hope for. Until then, my boy, that's a long answer to a short question, Chris. Jeez Louise. But until that confidence that I can get my metal whenever I want it, until that breaks, then the banks will just keep playing the same game.
Although you don't feel like, I've heard some of your comments and we've talked off air and on air before, but you don't feel like we're necessarily getting close to that point yet.
Not yet. No. Look, there's not the way things are priced through these derivatives. People think that somehow physical supply demand has some kind of impact. I don't know, maybe a little tiny bit, but think of just last year alone. We know that the central banks had their largest demand for physical metal, for physical gold, in like 50 years in 2018. It was like 650 metric tons. What was price doing in 2018? Right?
Yep.
Then in 2019, they did even more, 670 or something like that. Yeah, price finally began to rally in the back half of the year, but that wasn't due to demand for physical metal. That was due for demand for gold in all its forms, like I said. And so we talk about the COMEX. Open interest, total amount of contracts on the COMEX was up 73% last year. Okay. It's 1,000 ounces per contract. We went up, whatever it was, 300 some odd thousand contracts. Okay. The banks created 1,024 metric tons of digital gold on the COMEX and sold it to the speculators that were looking for gold price exposure. So what had a bigger impact in price? The 670 metric tons of physical demand from the central banks, or the dilution of the float by this creation of 1,000 pretend ounces?
Right.
So again, until those 1,000 ounces that the banks created are actually demanded by speculators at bottom, they'll just keep going. I mean, the open interest got to 800,000 recently, which was an all-time high. As price keeps going up this year, it may go to 900,000, may go to 1 million. And the banks will just, they'll continue to play the game as long as they think they can. And until they're forced to deliver metal, nothing's going to change.
Yeah, it does seem like all they know is they have a hammer, see a lot of nails. Along those lines, you've mentioned before about last $10 of the move in silver in April of 2011, and was wondering if you could dig into the mechanics of that a little bit. What actually happened, whether there was short covering or whether that was speculation. I've heard you touch on it. Maybe you could just add a little detail to what actually happened, maybe what people could keep an eye on going forward.
Yeah, this is one of the big misconceptions, what do you call it, urban legend almost, of that rally in silver. Remember, it went from 18 to 48 in about 8 months.
Yep.
Okay, from August 2010 to April of 2011. And as you now know, you've documented this. You talked to Bart Chilton right before he passed away about this. The banks were naked short. Primarily, J.P. Morgan was naked short. They didn't have any metal. They didn't have a COMEX vault. They didn't have any silver. They just had this massive short position that they defended by putting more shorts on, thinking eventually price will roll over and everything's fine. Well, price did not roll over and it kept going. I was paying attention at the time because TF Metals report was just kind of getting rolling in the spring of 2011. And so we were watching the commitment of traders data every week. And you can actually go back and look. I don't even know if they even still have, if you can find this historical anymore, but I can assure you this is what happened. In that final month of April 2011, when price went from 38 to 48. Again, the urban legend is, that every shoe shine boy and taxi cab driver was telling everybody, hey, buy yourself some COMEX silver, okay? It's going to the moon. And that created some kind of blow off top. That wasn't true at all. What was happening was a commercial short squeeze. And that final 20% of that move from 38 to 48 saw the speculators selling, liquidating, which allowed the banks as they were covering, as they were buying back their short positions and covering. And so it was not a speculator driven, managed money, shoe shine boy speculative bubble. It was instead a short squeeze. And then if you understand that, then you understand what happened next. We're right on the verge of moving to all-time highs on May Day of 2011. What's going to happen next? All the press it's going to get. And then you get the Sunday night massacre where prices smashed for $6 in about 7 or 8 minutes. And then you get 5 margin hikes in 9 days, and whatever left of the speculators are then chased out, and that pressure is eased. At the exact same time, JP Morgan gets approved, rubber stamped in like rapid fashion, to start their own COMEX silver vault. And over the next, whatever it's been, 7 or 8 years, they've consistently stopped taking delivery of silver every delivery month into their house, their proprietary account. And now they've got like 160 million ounces. And so now what they do, this is simple, man. This is like free money. This is why silver is not going anywhere, because you get an exemption from the CFTC. We know that just from their latest CFTC article about position limits. So, well, if you're a bona fide hedger, you get exemptions. So JP Morgan, with 160 million ounces in their eligible account, what is that? 30,000 contracts? So they could legitimately, in the eyes of the CFTC, be short 30,000 contracts of silver, and it's just a hedge against their 150 million ounces in the vault.
Yep.
This is pretty easy money, man. You and I got to get a piece of this stuff, because you can just sit there, take your short position down to nothing when the price is down at 14, then run it back up to 30,000 contracts when the price is at 18, roll the price over, get the specs dumped, buy it all back. Then that bonus pool, that buys a lot of vodka and hookers at the office party, man. That's good money if you can get it. And then if it ever gets away from them again, well, then maybe they'll just stand down and let it go. But in the meantime, you want to know why silver is not going anywhere, and it hasn't been going anywhere? It's because JP Morgan has a monopolistic control over the pricing scheme. I mean, it's, God, I'm sorry, Chris. There's another 10-minute answer to it. 10 seconds.
It was a good 10 minutes. And, I appreciate you pointing those things out, how widely the world is recognizing it. I guess we'll find out yet. Appreciate people like you speaking up about these things, because like you said, they put Jamie Dimon on 60 Minutes like he's, Uncle Jimmy, and we should all be thankful when, I don't know if you ever read that book, J.P. Madoff by Helen Chapman, which goes into how they were the sole banker for Madoff, and 200 pages of felony after felony.
Right.
Which is
screwing veterans out of their mortgages. They've had to pay a multi-million-dollar settlement for that, or all the MERS stuff, with the fraudulent paperwork, because mortgages got sold and securitized through all those CDOs and CMOs and all that stuff in 8 and 9. So nobody knew who owned a mortgage anymore. So they would just fraudulently make up paperwork and claim they still owned it, and then try to default on people. I mean, and that cost them a couple bill. I mean, how people look at that. How people work there, for God's sake. I mean, you might as well be, shoveling coal in hell as a job, and trying to say that you're helping things out. I mean, anyway, I digress.
Well, real quick before I let you run, along those lines, I went to get a salad at a local shop a couple of weeks ago, and the girl who was working there, she mentioned that she used to work for JP Morgan, actually reviewing those mortgages that people were getting screwed on. And even buying lunch, it was amazing. Someone pops out of left field saying basically what we've all been saying and seeing, and her best line was, she's like, I'd rather be making falafel.
Yeah, and not have a guilty conscience. Yeah, no doubt about it. And just one last thing before we wrap. So I mentioned palladium. In the most recent bank participation report from the CFTC, it revealed that the bank net short position in palladium has now been cut by 70% from where it was 2 years ago.
Yep.
Okay, now price discovery, this thing's not being driven on COMEX. This is a London issue, okay, and physical supply issue. However, the bank's trimming their net position by 70% with a rising price. That makes me think they're finally going, we don't want to get on the hook here. Because when we talk about COMEX failure and all that kind of stuff, and all the ounces in the vault of silver versus how much open interest there is, and how many ounces of gold there are versus the open interest, there's like 80 ounces of digital pretend palladium. Okay, there's like 2.3 million ounces of digital palladium trading on the COMEX. There's only like 40,000 ounces in the vault, so there's like 80 pretend ounces for every one. digital ounce. So watch palladium. That would just be the last thing I have for people. Scotiabank says that the above ground stocks of palladium in the world are going to be exhausted by this summer. I mean, it's zero.
Yeah.
So how the bank's going to find palladium for their promissory notes and their leases and all that stuff in London?
Is interesting how they've been backing off palladium, but just going double down on platinum, gold, and silver.
Yeah. Well, that's just it. I mean, it's like, again, they don't think, look, I don't know. You and I might be a little more prudent about this, right? But these,
that's debatable, at least half of that sentence.
Yeah. The banks just see profit, and the way it's always worked. And they'll continue to do it until they can't. And that's where we hope palladium. If that market does fail like it looks like it's going to later this year, then all we can hope for is it's not just a one-day headline. And like I said, Druckenmiller and Dalio and Kyle Bass and all the rest go, oh, wait a second, I want my gold right now. I see, your scheme in palladium just blew up. I'm not taking any chances. And then, things kind of, but until something like that happens, the banks are just going to try to keep screwing everybody every chance they get, because that's what they do.
I hear you, and I wonder when Dalio or one of these guys will call you. I mean, it's like depending on these MBAs where, I worked on a trading floor and knew nothing, yet the information you're putting out there, if I were Ray Dalio, I'd be on the phone with you like I am today. And Craig, I know you have a article to write for Sprott Money News, which I'll recommend to folks. Your articles are great. You do that weekly call with Eric Sprott, and perhaps you can mention your site as well and anything else that folks should be aware of.
Yeah, TF Metals Report is my site. We've been doing it now for about a decade. There's a small fee to be a part of it, $12 a month. But I use analysis like this every day and a podcast every afternoon, and we're always looking at the mining shares and everything else. And I think trying to stay ahead. I mean, I told everybody last year it was going to be the best year in the precious metals since 2010, and we were right. And if you positioned yourself for that, you probably made some fiat. And so we're still looking ahead this year in the same way. But however, I'll shut all that shit down in a heartbeat if Ray Dalio wants to pay me $5 million a year to be his head gold trader. So just everybody on notice.
Well, I know Bill Murphy's buddies with him, so maybe you can pass.
Yeah, okay. I sent him my resume or something. Yeah.
Ray, if you're watching the show, Craig has my endorsement, and it'll be interesting to see when the rest of the world realizes what you've been so far ahead of the curve on. And that said, we'll wrap up for today. But thank you, as always, for joining me. Sure is a pleasure, and appreciate everything you're doing and you shared today.
All the best, Chris, and keep plowing forward. We appreciate all you're doing.
We'll sure do, sir. So that is today's episode. I do thank you for spending some time with me and hope you enjoyed it. If so, go ahead and hit that subscribe button, and I'll see you again soon.